For more on the markets and the earnings so far, let's bring in Keith Banks, Vice Chair and Chief Investment Officer of the Pension and Benefits Plan at Bank of America. It's good to have you on, Keith, to get a sort of a broad perspective. And I'm not going to have to, shame you into your calls. You haven't been on in a while. And you probably, in charge of pension plans, you need you need to stick to some pretty rules in terms of asset allocation. You're going to need fixed income. You're going to need a stable part of a portfolio for pensions, but you're going to need to be invested in stocks as well.
Correct.
So I'll bet I can't ask you at the beginning of the year what you felt about the markets, can I? You were probably fully invested, depending on where your assets are allocated.
Correct. I mean, look, at the beginning of the year, we were certainly not as bullish as the market has played out to be this year, Joe. But to your point, our recommendation early on was to be fully invested in equities, fully invested in fixed income, depending on your risk profile, if alternatives made sense. And we've really maintained that posture throughout the year. And having that balanced approach helped us because obviously having exposure to both value and growth when growth really took off, especially technology, being there and being exposed to that was a good thing, clearly.
We wanted more breadth, obviously, after the Magnificent Seven. Now we've got the Dow. I don't think of as the Russell or as broadening out, but 9 days in a row is pretty significant in terms of our expectations for a recession. Is it not?
Yeah, it's good. I mean, look, the Magnificent Seven, as they now call it, drove 73% of the first half returns, which is crazy. The stock on average, each of those seven was up 90%. Obviously, that's not sustainable from a driving the overall market standpoint. Right. So we do need to see the breadth broaden.
Does the Dow count if it widens to the Dow? Is that breadth widening?
It helps.
We need the S&P and Russell.
We need the S&P and Russell.
Well, the S&P's no slouch.
No, S&P is up 19% right now. But again, if you look at the equal weighted versus the cap weighted, there's a big difference.
Still a big difference. But you point out that the long-awaited recession may be a series of rolling recessions that don't add up to one big back-to-back quarter of negative growth. We may not get that.
That's been the interesting thing. So we've got a $26 trillion economy that is basically made up of different sectors operating at different speeds. So what we saw during the course of the first half was a rolling recession in manufacturing, in energy, and you had in housing clearly as well. So that's kind of playing out while the services economy is booming. So instead of having the balloon pop, there's been a slow letting out of the air. We've got 2% growth in the first quarter. Our economists think we're going to see about 1.5% in the second, but then a continued deceleration through the rest of this year. And they have a very mild recession built into their forecast in quarter one and quarter two, like -1% in quarter one, -0.5% in quarter two, and then you start to come out of it. So we think this rolling recession has really kind of taken out that big bang risk of a hard landing, which a lot of people were worried about at the beginning of this year.
So we need to adjust 2024 earnings estimates then, or have we already seen the low in corporate earnings?
So our BofA Global Research right now is at about 235 for next year. It's still early, but that's...
So you can throw that... So this is not you, this is BofA Global Research. If these guys are wrong, I mean, you can't do anything about that, can you? So what do they say? You're subcontracting this out.
No, well, we rely on our partners. And that's,
you do?
Oh, yeah, of course.
Okay,
We've got some very talented...
get rid of them.
We've got some very talented teammates that we're able to work closely with. So they're looking for 235 next year. I believe the consensus is at least $10 higher than that. If we get that deceleration of earnings, my guess is you could see the 24 estimates pull back.
Yeah.
But I think, Joe, if we get to the point where we start to come out the other end, where earnings plateau and then begin to grow again, if we do get a sustained, greater breadth in the market, we think those could, in fact, be catalysts for the next leg of the bull market. And at the same time, that would allow the Fed, if inflation continues to surprise the way it has in the downside. Because think about it, last June, if CPI was 9%, this June, 3%. Now, core is higher. Admittedly, it's still too high, but that's a heck of a positive delta. And we think that will continue to show more and more.
So the Fed
benefit.
goes one more time, in your view?
Well, we're still calling for two. We think the economy is still strong enough and inflation is still sticky enough, even at these lower levels.
That's 50, though. We used to do 75 at each meeting.
Yeah,
So
and if all we get is 50, that's not so bad. That allows you to look over the valley to the other side.